John now comes to the final step in the financial planning, which is the summary of expenses, tax, savings, return on the savings, and so on. So if you look at these columns, let's go one by one. Coincidentally, and it's a coincidence, his total income over 35 years adds up to 5.25 million, which coincidentally tallies with the expenses for his entire lifespan, which is 5.25 million. There's no relationship there. It just so happens to be so in this example. He pays tax every year, which has been shown. The aggregate value is shown at 35%. In reality, what will happen is, as he starts his career earning a small sum, the tax burden will be less, 10%. Then it goes to 15%. And perhaps when he's about to retire and when his salary is high at $200,000, he's paying close to 40% tax. The weighted average of it is shown here as 34 to 35%. At different points in time, when John has a life event like a wedding or a house, he may not have the cash with him, which he has saved. Therefore, he needs to borrow from a bank or from an institution. Those don't figure here, the cost of interest, etc. But this sums up and tells us a few important things. The first is that lifestyle has to be pretty consistent all through these years. Number one. Second, broadly, 35% will go away towards taxes. Third, very important, if you look at it, 70% of investable saving comes in the last 10-15 years. So when you're young, your salary is not going to be high and therefore you will save, but that's not going to amount to much except for the fact that time will act on it and will increase and appreciate it over a period of time. But invariably between 40 and 65, bulk of your savings come, and therefore you need to be fit, you need to do well in your job, and you need to do well in your life. And lastly, this table tells you a very interesting rule of thumb, 4:3:3, which means 40% of what you get can go towards expenses, 30% towards taxes, and the next 30% towards savings. It's a tough ask because expenses come and go, and there are peaks and troughs, ebbs and flows, which you cannot control. But if you can broadly work between, say, 40 and 45% of expense, 30 to 35% of tax, and anywhere between 20 to 30%, therefore going towards savings, which in turn goes into sound investment, you will end up in a good shape over a period of 35 years. This is the essence of financial planning. Although highly simplified, it does convey a couple of lessons to all of us.
Thank you for watching. If you want to dive deeper into this topic and stay updated on our latest content, be sure to subscribe now. And if you found this video helpful, don't hesitate to share it with someone you know. Let's spread the knowledge and the fun together.